Friend, hold your breath. A financial earthquake far more devastating than any Federal Reserve rate hike or cut is looming. It's called the U.S. government shutdown. Many will dismiss this as just another political farce that plays out every few years in Washington, D.C. Politicians bicker and argue, eventually reaching a compromise before midnight. However, if you still harbor such hope, you could pay a heavy price this time. This time, it's no longer a minor budget dispute between two departments. This is a fatal blow to the very foundations of the American system. This is a brutal stress test for every penny in your and my stock accounts. When even Trump dares to utter such harsh words as "let's close it down" even harder and more thoroughly, you should understand that the old world's credibility has completely collapsed. We must face the harsh reality. The U.S. government is essentially a massive, centralized super-operating system, and congressional appropriations approval is the core consensus mechanism that keeps it running. In the past, everyone had a tacit bottom line: the system couldn't crash. But now, this consensus engine has completely froze. The Republican proposal in the House of Representatives was rejected with a dismissive and resolute gesture by the Democratic-controlled Senate. Behind this is no longer a quarrel over tens of billions of dollars, but an irreconcilable, hysterical head-on clash of core values between the two parties. It's like a blockchain network facing the risk of a permanent hard fork or even system downtime due to disagreements on a core code upgrade. What happens when the foundation of trust in a system begins to waver? Capital will flee. U.S. dollar assets will flee. Global investors will be forced to reassess the risks of holding U.S. dollar assets. This is the core of the problem. The government shutdown is not a fiscal issue. It is a devastating crisis of trust. The U.S. government shutdown isn't simply a budget dispute. Its impact on the market and the economy is often profound. Historically, the U.S. has experienced dozens of government shutdowns since 1977, with an average duration of approximately 8 days. The longest, however, was the 2018 to 2019 shutdown, which dragged on for 35 days. This shutdown directly cost U.S. GDP approximately $11 billion, and the Congressional Budget Office estimates that economic growth for that quarter was reduced by 0.2 percentage points. Goldman Sachs research also shows that a full shutdown lasting even a week could reduce GDP growth by 0.15 to 0.2 percentage points. In other words, the longer the political deadlock drags on, the more damaging the damage to the U.S. economy will be. The economic damage is only superficial. The deeper impact is on trust. Every shutdown is essentially a stress test for the U.S. credit system. Investors are concerned not just about furloughed government employees and national park closures, but about the uncertainty itself. Wall Street's biggest fear isn't bad news, but the fog of uncertainty. When the Federal Reserve is unable to obtain even basic economic data such as non-farm payrolls and CPI on time, monetary policy loses its reference beacon and the market falls into chaos. Historical data shows that stock market performance during shutdowns is often volatile. During the 2018 shutdown, the S&P 500 and Dow Jones indices came under short-term pressure, and investor confidence declined, but they often rebounded after the shutdown ended. In other words, a shutdown itself won't directly devastate the stock market, but the uncertainty it creates is enough to prompt a preemptive sell-off. Just today, Dow Jones and S&P futures have fallen 0.5% to 0.8% due to shutdown expectations, and investor nervousness is palpable. In contrast, gold is often the biggest beneficiary. As humanity's ultimate credit asset for millennia, gold has been re-embraced during every government credit crisis. On the first day after the current shutdown was confirmed, the price of gold soared to $3,875 per ounce, setting a new record. Gold's strength stems from its independence from any government policy and its inability to be held hostage by fiscal gridlock. It serves as the ultimate anchor of value. As for Bitcoin, its performance is more mixed. During the 16-day shutdown in 2013, Bitcoin actually rose 10% as investors viewed it as decentralized digital gold. However, during the 2018 to 2019 lockdown, Bitcoin fell nearly 10%, a period marked by a bear market. In other words, Bitcoin's performance during a crisis depends on market conditions. It can become a safe haven or be sold off as a risky asset when risk appetite declines. Currently, with the anticipated 2025 lockdown, Bitcoin has already experienced a short-term decline of approximately 1%, but it may still serve as a hedge for a small number of investors. Politically, this crisis is more complex than ever. Trump publicly threatened to permanently lay off furloughed federal employees if a shutdown were to occur, a statement that immediately alerted the market to the shrinking window for political compromise. The Biden administration emphasized the harm a shutdown would inflict on ordinary Americans and demanded concessions from Republican hardliners. However, extreme factions within the GOP insist on spending cuts and are unwilling to budge on healthcare, welfare, and the social safety net. This isn't just a dispute over tens of billions of dollars. It's a head-on clash of fundamental values between the two parties. Wall Street is also offering its own assessment. Goldman Sachs explicitly states that each week the shutdown continues could slow U.S. GDP growth by 0.15 to 0.2 percentage points. Morgan Stanley has simulated various scenarios. If the shutdown lasts more than 2 weeks, U.S. stocks could fall 3% to 5%, accompanied by a widening of U.S. dollar credit spreads. Moody's chief economist Mark Zandi warned that if it drags on for too long, the Federal Reserve's policy guidance will fail, potentially triggering a broader crisis of confidence. What can ordinary investors do in this situation? First and foremost, reduce their risk exposure. If you hold a large number of high-volatility growth stocks, these stocks often suffer the most during market panics, so controlling your holdings is crucial. Secondly, cash is your bullet. Maintaining a 20% to 30% cash balance during a panic ensures you can sleep soundly while also being able to buy dips when the market crashes. Third, an allocation to safe haven assets is essential. Conservative investors can consider gold ETFs such as GLD. More aggressive investors can allocate a small amount to Bitcoin to hedge against the risks of centralized systems. It's even more important to prepare a shopping list in advance. Market panic will inevitably lead to indiscriminate selling, even for companies with solid fundamentals. For example, if Apple's price drops to the $150 to $170 range due to market sentiment, it would be a good opportunity to buy in batches. Microsoft's price drop to the $250 to $270 range would also be worth holding for the long term. Nvidia's high valuation will lead to greater volatility, so long-term investors might consider buying if it falls to the $350 to $400 range. Berkshire Hathaway and United Health, as defensive holdings, may see limited declines, providing stability during market panic. The IWM Small Cap ETF could decline 15% to 25% during a panic, but precisely because it's been oversold, it could offer greater potential for a rebound. Ultimately, no one can be completely certain whether the government shutdown will become a golden bargain hunting opportunity for the U.S. stock market or the beginning of a new bear market. Historical experience tells us that short-term shutdowns are usually disturbances and will not cause systemic crises, but the context this time is different from the past. The United States has high debt, serious fiscal deficits, excessive financial leverage, and the market's tolerance for uncertainty is far less than it was a decade ago. Therefore, truly intelligent investors won't give in to emotional panic or blindly gamble everything on their investments. Instead, they equip themselves with calmness and data. On the one hand, they acknowledge risk and reduce their exposure to high-risk investments, while on the other hand, they must be prepared to seize opportunities when the market misses its target. As Buffett said, "Be greedy when others are fearful," but that greed must be based on thorough preparation and rational judgment. Now, tell me your choice. Do you think this shutdown crisis will be a golden bottom fishing pit for the U.S. stock market, or a bottomless abyss that will mark the end of the decade-long bull market? Leave your judgment and reasons in the comments. Through the collision of ideas, we will navigate the fog.